On to another quality presentation of Trademonster Education. It's February 20th, and today we are to translate the Greeks. Ralph Michel of the Omega Institute of Trading. Now they've given us, the Greeks gave us philosophy, and the modern Greeks have given us feta cheese and yogurt and Euro sandwiches. They'll give us of how much risk that our options positions hold. And Ralph Michel is going to help us run through those details today. Options involve risk, and they're not suitable for everybody. Investments involve risk, and the past performance of a security, industry, sector, market, or financial product does not guarantee future results or returns. Keep in mind, certain thin margin policies may limit or prohibit the execution of some of the methods being discussed today. So to ensure that you're in compliance with these policies, please contact your brokerage firm before executing any order. You may get a copy of the Options Clearing Corporation's Characteristics and Risks of Standardized Options brochure by sending an email to info@trademonster.com. This is an offer or a solicitation for brokerage services, investment advisory services, or any other services in a jurisdiction where the Trademonster Group is not authorized to do business, or those types of offers would be contrary to the securities laws or other local laws and regulations of that jurisdiction. The content provided to us for educational purposes only, and we hope it's a very educational seminar today. Certain content has been written by and will be presented by our third party who is not affiliated with Trademonster or the Trademonster Group. The information contained in this material has not been endorsed or approved by Trademonster. So the content neither is nor should be construed as an offer or a solicitation of an offer to buy, sell, or hold any securities by Trademonster or the Trademonster Group. Remember, all of the decisions that you make in your trading account should be based solely on your evaluation of your own financial circumstances, investment objectives, risk tolerance, and liquidity needs. And neither Trademonster nor any of our affiliates are connected with the third party providing content today. While waiting, you might have noticed our social media addresses. Please follow us and like us on Facebook and Twitter. Trader Bytes Daily blog for trading news, insights, and tips, and our YouTube channel to view videos about the Trademonster platform trading tools. To bring back our presenter, a number of times already. He's very knowledgeable, and he's a very good trader and educator. We're very happy to have with us Ralph Michel today to translate the Greeks for us.
Thank you so much, Don. I really appreciate you having me again. I certainly love coming back here. It's nice we get to our monthly chat, and thank you for making me the presenter. I will share my desktop. We have got the presentation in there, but my screen, monitor 2. You got to be able to see my screen here in just a second. Right there. Okay. And it's the chat up. So can you guys all see my PowerPoint presentation? Excellent. Thank you. All right, let me get it back onto slideshow, and we'll get rolling here. Current slide. Excellent. So, oh, sorry, that's the wrong name. We are going to be talking about, I didn't fix the name on the slide. We'll be talking about the Greeks today. And so, do apologize, I'll have to fix that. Anyone needs the copy, I'll be happy to send them slides. I know you just went through an awesome bunch of disclaimers there that Don went through. Like you say, I'm not employee of Trademonster, so I am a third party, and I'm here to give you guys educational information. I am not a licensed broker. Okay, the licensed broker room is Don. So any questions about licensing questions and trade questions, you can ask him. If you need a platform to work with, obviously he can help you with getting an account opened at Trademonster. So I'm here for educational purposes only, and anything I bring up as trades are not to be construed as recommendations. Okay. Let's get rocking and rolling here and get into some of the absolute basics. Currently paying attention to what the Greeks are doing their trades now. that. You really should be paying attention to what the Greeks are giving you in terms of whether volatility, low volatility. I want to talk a little bit of volatility as well. With that being, I know the Vega, which is one of the Greek letters, but I do also want to have a discussion also about VIX because it does greatly affect the pricing of our options. And, when people start looking at the Greeks, there's 5 Greeks that we need to look at. One's pretty, in terms of what it does, which is rho, which has to do with interest rates, and obviously with interest rates where they are, I'm going to spike to 18% of interest rates. So that said, there are 4 major Greeks that we want to look at, and there's also VIX, which is indicating of just pure volatility to begin with. So it's helpful to know what the VIX is doing, and the reason for that, folks, is someone asked me about placing a trade. Like we just did my weekly coaching just before this, and we've actually placed 2 trades on the same underlying stock, one spread and one a directional call, because we'll see how both of them will work out. But knowing that one is a time decay method and one is a sucker of just out time decay, 2 different types of trades, they're both bullish. When volatility is high or low, we can discuss what is going to happen when you put on a trade with volatility or low volatility. Okay, so that also will play into effect. Jim, what I encounter? Yeah, we'll discuss it. I've got a chart that I'm going to share with you guys, and you can email me. I'll give it to you. It's a chart about the Greeks and basically every position that I can think of, and what the delta, gamma, theta, and vega is. So you see that this iron condor, the 0 kind of being like a neutral delta, okay, and then the positive, theta, positive theta on an iron condor. So go out there and grab the negative theta, positive theta, negative right? So and there are reasons for all that happening. You can email me later on. I'm happy to send that to you. With risk of a $1 move of the underlying stock, okay, directional risk. They'll understand a few different things, and we're going to dive into it a little bit more in a bit. But delta, whether a positive or a negative, is purely going to tell you, at least from the positive negative number, whether bullish or bearish. Okay, so look at your account and you see that you've got a positive number. That means if you got positive deltas, that means that you are bullish. And if you are negative deltas, that means that you are bearish. Okay, how much you are, depending on how many shares you are controlling. First dollar move of any stock is what delta is going to help you with. Okay, that's directional risk of a $1 move in the underlying. Okay, so the $1 move, if $1, and delta is going to give you how much that option is going to move based on $1 move in the underlying. Okay, that's what the first dollar move is going to do, and that's delta. Well, what happens with every subsequent dollar move after that, right? Because that the delta is changing, and delta is changing, what's changing delta? Okay, some stuff might want to burst your head on this stuff. Issues here with it takes a bit getting used to, but if you think about it, one move, there's, well, you get a new delta. And then what is it? There's got to be something that's going to accelerate delta. So that's gamma. Okay? So got your delta and they got gamma. And what gamma is, okay, take a deep breath, is the rate of change of delta. So it's not like the delta is delta. Right? That $1 move, gamma is going to tell you what for the next dollar move. And the dollar move after that, and then the dollar move after that. So your gamma is going to show you the rate of acceleration, is, I guess, the way you could say it. All right, just take a breath. All right, got a slide for each of these and working some of the stuff out. Okay, theta is our time decay. Okay, theta is time decay. So everything is designed to decay in value over time, every day, included. So for 3-day weekends, you're getting an extra day of time decay. Okay, so what I have here with theta is it's going to give you decay is of time and have an understanding of what option is doing. And know what theta is helpful because if you're an options buyer, then theta is working against you. If you're an options buyer, you bought an option, you need to go up in value to make money. But if decay is ticking away a few pennies every day and that option isn't going anywhere, well, it's not going anywhere and you're losing value in the option because of decay. So it's at 50, and it doesn't move a penny. You didn't gain anything. Option that's based off that stock's movement, and a week goes by, stock has gone from 50 and it stayed at 50, which is not going to happen, but it stayed at 50 for a week. Lose 7 days, not 5, 7 days of time decay, and stock has gone nowhere. You lose money because of 7 days of that time decay going by. So as a stock buyer, an option buyer, you don't worry about the time decay component working against you. As seller, you working for you. You two sides of the coin and say, where do I want to be? And that's going to be purely dependent on price of your options, strategy you pick, and the risk that you're willing to take, as well as your probabilities, right? Because there's got to be it's got to be worth it for you to get into these trades. It has to be. And then one other. So when you look at this, you'll be able to say that and why I got into my trade. I'm long, I'm bullish, so I've got positive delta. I've got long call, so I understand that time decay is working against me. And the fourth component, what happened there? Let me go get that back up. Sorry about that. Which is the two options, one move in volatility. All right. VV, Vega volatility. Sensitivity to an option to a 1% move in volatility. So if volatility moves on you, you know if volatility is going to hurt you or help you. So if you have okay, guys, what is the volatility? What drops? Does it decrease? Okay, so from the standpoint, if you had a put and you're bearish and you buy a put on a stock that you want to go down, you have delta, which tells you are bearish. You have a positive theta, negative theta, because you are going to lose money on time decay. A put right here. Neta. You're bearish. You're going to lose money every day, okay, on the time decay. But you have positive Vega. And what it means to you is used to drop. You might lose a day on the fake position, but you make back on increase in volatility. Because volatility rises and you have a positive number, then it's in your favor. Okay, so components of options that work for you and against you. If you call and it goes up, volatility will typically decrease. So if a call option, and I get this a lot from clients, not but often, I'll get someone who says, I don't understand. I bought a call, it ended up, lost money. And what Vega was. Did you understand that time decay was working against you? You know what that means. So you money on time decay, that's a guarantee, right? But if you buy something, if you buy a call option with volatility, and that volatility saps away like popping a balloon, you're losing on volatility. So it goes up slightly, but volatility gets just completely sapped away from the whole position, you lose money. So to have a kind of a good understanding that what go wrong for me, buying into high volatility or low volatility, what is the VIX doing? I know it's Greek, but it's important to know. The historical volatility is important to know. Or buying a call option 3 days before earnings, which 3 days before earnings of a call option would be pretty expensive, right? If you're going to buy a pretty darn expensive option, earnings popped like a balloon on that, then what's going to happen on that? We're going to go into it. So I'm just scenarios at you as you can, and let the rest of it go. All right. Row is the last one, which is the option price sensitivity to interest rates. Been pretty much a non-existent factor for quite a while, and really, these don't really affect the short-term options as much as they do the longer-dated options. Yes, I will get my email out to you guys in a second. Later on, I'll promise you. I'll put it in here. Consider IV. Consider will be high at the end of a long trend. Bottom, if go long at the bottom, are disadvantaged since IV will lead as prices rise. I'm not too concerned if you're buying with volatility that's already low and a stock starting to rise, and the volatility is going to kind of play a little bit. It's the nature of doing business. With the VIX being so low right now, options prim is pretty darn cheap. Seeing a very, very, good priced option right now. And because that, I have to understand that you need that stock to move up for money, but you need to move up significantly. You can't buy a one strike in the money call, have it go up $1, and then you make a good amount of money over weeks, right? To have in 5 minutes, that's one thing. I will place trades on buying calls, knowing that I'm going to lose money on time decay and on Vega because I'm expecting a big move. More of like an idea of what is the risk reward you are looking at, and for you to place that trade. Because it's a question. Do I worry about it to the point where I don't take the trade? And you know what? There are times where I don't. And this is a bit of a segue or sideway, off topic. But I take a trade that doesn't have, I'm buying a call, buying a put, directional, I want a trade that has a bare minimum of a 2-to-1 reward to risk ratio. Bare minimum. Okay? So that if I'm going to make money on this trade, I am going to double what I'm risking at a bare minimum. Okay? So yeah, if I can't basically see a good move in that stock against me, if I get like a little, a GE that doesn't really move, what happened? I anticipated a good move, it didn't happen. I'm going to lose money. Let's take a look at this chart again, and yes, I will get to you. By this buy call, I'm going to lose money on every day. And positive Vega, which means to have the volatility increase. But as stocks rise, right? If stocks are rising, there's volatility, just like the VIX. When the market goes up, the VIX drops because there's less fear, right? So I know that I've got Vega and Theta working against me when I call. I know that I'm going to place a trade like that. I want to find this Excel file for it, just so you can kind of see what I'm talking about here. Don't worry about trying to write down everything that's in that Delta against Theta Vega. I will be happy to email to you. One sec. Okay, we go. So this is what I like to look at. I write this down, but you can't see what I'm writing. So 1-to-1 risk trader. I'm gonna have 10 trades, 5, lose on 5. It's not really a successful trader. Your broker's gonna love you because you're gonna have a lot of commission, but make any money. Well, trade like this, knowing that I'm gonna have components of my option work against me, you're gonna lose. You're not even gonna break even. Because even option, well, if a stock goes nowhere, you're getting money every day. So really, 1-to-1 risk reward is useless to me. I really prefer to be at a 3-to-1, 2-to-1 is a minimum, where I'm basically taking 10 trades, and I'm okay with being right 4 of my 10 trades, because I want to make 3. If that's the case, I such a large move that I'm risking the $1 and I'm looking to make 3 on my other trades. So I'm expecting a good move. If I'm going to do this type of trade at a $55 stock and I've got a $3 stop loss, it means expecting for a $9 move in the stock. If I get a $9 move in a stock, my option is going to be going up a pretty good clip. So losing on the Theta and the Vega has increased pretty well, and again is moving that delta up for me because it's moving up. Okay, so not that I hope you guys don't mind that segue a bit there, but the loss on Theta and Vega on a call become expecting a big move. Okay. Delta. All right, there actually is 3 definitions of about delta. Okay, I think there are 3 different pieces to delta that really can help you understand what it's doing for your trade. So it's the amount by which an option's price will change with a $1 move in the stock. Okay, that's a base simple number based off math. If you've got a delta of 70 stock dollar, you're making 70 cents. Right? Option is stock moves up $1, you've got a delta of 40. You're going to make cents on that dollar move. All right? So that of the easy math, the amount that it's going to move with that $1 move in the stock. Here, how much your option is going to move down. All right? About of your delta probabilities. Okay, the probabilities the option will be in or out of the money on expiration. Just analyze these to your trade that you can look at with the Trademonster platform. All right, if you're just looking at an option, see a delta of 65. If I buy this option, there's 65% probability that stock will be above that strike price on expiration. This is a quick, down, dirty kind of curb appeal to a house that you're going to buy, right? You drive by a house, it looks gorgeous, you want to buy it, it's for sale, you sign a piece of paper, give them a deposit, and then you go to contract, and then you nitpick, you have it analyzed, you have an engineer go in, you have it looked at, you know, check for leaks, check for cracks, check for broke stuff, right? But at least the curb appeal get by and said, this looks nice. Well, the probabilities of delta, the use delta's probabilities, can do that curb appeal of what's probability. Do you buy a call option that's 40 delta? Because what to you? If you've got a 40 delta option that you're going to buy, there's 60% probability that you're not going to make money, or at least even break even that option. Okay? So understanding that delta will tell you how much the stock's going to move, $1. It's going to tell you your rough probabilities. And get sometimes is someone who's like, you know, new to options and they want to, options cheap. They're efficiently priced. To make options cheap is go like 10 strikes out of the money, buy 30 option or something that's ridiculously no value to it, and then you're out and not know that you have a low probability of making money. Because if you go way out of the money and get a low probability that you are going to get that option or that stock to move to strike price. Okay, higher the number, okay, you are at the money to enter the money, right? So a delta of 90 is definitely an in the money option. A delta of 10 is an out of the money option. Okay? With how many shares you are controlling. About like a delta of 70, right? Each controls 100 shares of stock. Right? So if you basically think about it that way, with delta of 70, at 100 shares of possible ownership, you're kind of controlling like 70 shares, controlling the whole amount. Okay, moving it dollar for dollar. It was moving dollar for dollar. You're basically acting as if you're controlling 100 shares because it's making as much money on par as that stock does all the way up. Okay, a delta of 1 is going to make a dollar for every dollar move in that option in that stock. Okay, I'll move $1 because the stock moved $1. Right? That's a 1-for-1 parity, and it's really where you're controlling 100 shares. Anything below that, you're kind of controlling less than that 100 share. Even contract controlling it. Does that make sense? You know, option contract controls 100 shares of stock, but helping you understand that it's moved 50 cents or 70 cents on the dollar. Okay. So loans have positive delta, negative delta. So get into kind of a quick example here. All right. Say you have a delta of 54. All right. And delta of 54 basically is giving you that $1 move. If it moves up $1, you're going to make 54 cents. Okay. Let's say stocks at, the option, the delta is at 54. You buy an option $3. Delta component of your option after $1 move is now going to be worth $3.54. Okay, time decay and the volatility mega components also then take some money away from you, but you have 54 cents on a $3 option with a $1 move. It's also tell you that there's a probability of roughly 54% probability of being, at least 1 penny at expiration. All right? You're controlling about 54 shares of stock. Okay? Again, measures the change in the options delta. Okay? It's the velocity of delta's movement. How fast is delta going to move? All right? So the change in delta or the delta, right? Yeah, if it's going to give you the acceleration that you want to get dollar, okay? Bought options have positive gamma, okay? Negative gamma. So here, increase in value. Delta is 54. Is 11.1. So think is going to happen when delta goes from gets the dollar move in the stock. Okay, what's the delta of the next dollar? Think about that. You're 54. You're gamma 11. Okay, now the extra that now you get the $1 move. You had your delta gamma. Next move is 65. There you go. Thanks, Ron. Oh, sorry, I got the 0.11 in here, but I should have put the point in front of the 54. So 54 plus 11, which is 0.65. So your next dollar move now gets you closer to 1, right? Because now the stock's moving up. So getting closer to an in-the-money option or getting more intrinsic value in your option, or your intrinsic and extrinsic value. So after a $1 move, you get 11. Now, here's the cool thing. It is now. So let's say on the next dollar move, you get a 10. You go from 54 plus 11 to get to 65. And the next dollar move, getting another is 10. So that's a 75. And that, let's say the gamma goes to 8. So it's 83. Right? So that's how you can see where eventually you're going to be at parity, where you're going to dollar for dollar move with stock. Okay. I know this is a little bit of a tougher one because it makes a lot. There's not a lot of pretty pictures up on the screen. Okay. So then data, which time decay. Right? It accelerates over time. So it's not a constant number. The closer you get to expiration, the more you are going to see decay increase. For example, my little chart up here of the burning, the ice cube thing, 9 months, 4 months, 1 month, 0 days, right? Literally no time decay. I mean, you're barely creating anything. What happens is that the curve starts to accelerate pretty dramatically in that month. If you see, if you notice this curve and it accelerates over 30 days, it's a pretty dramatic increase versus the beginning of when we talked about the top of the all right. So it's going to increase over time. So it's going to get more and more, become more of a concern to you to the duration. All right. Inputs have negative theta. You are paying money for every day for time. All right. Negative theta. Bring this up. Boom. Okay. Option. You have positive theta. Okay. So that for a second. Okay. When you have positive theta versus negative something, that's all I care about. Just like example, if you are a car dealer, you start to somebody. If I'm the car dealer, I don't care if you have this thing lifted, put a flatbed, taken to your garage, it's put up on blocks, it's never driven. You decide after a year, you're going to drive that car back to my dealership. What am I doing for that car? Less for it. Because time decay, okay, incorporated with that car. 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 Time decay, okay, incorpora is going to lose value the second you take it off the lot, right? So you have to understand that that's going to be the case. So same thing here. As a buyer of options, you're going to have that go against you. If you sold it, it's going to work for you. So if your thing was like a 0.03, the option price should drop by 3 cents if the stock remains at a constant price. All right? Stock isn't moving. And you bought a call option. You're losing 3 cents. Happening. Okay? Stock, there's nothing there to be worried about. You own a stock, you buy it $50, tomorrow's $50, you get nothing. But with the option, use that option tomorrow, it's going to be worth less money. All right, the way it works. Critical. All right. Then you have your Vega. Vega is for volatility. This is kind of the one that it gets a little bit dicey. People don't want to care about it, but really forget about Vega. And measures the option sensitivity to a 1% move in volatility. So it's going to affect your price based off the volatility of that option. All right, options have positive Vega. Vega will help you with volatility increases, basically, and options have negative Vega. Vega will help you if volatility decreases. Okay, so what here is you have this component of your option that will accelerate the options price. All right, increase in volatility. Great if you use the option. But people don't get this. They don't understand why I sold an option and lost money. No, okay, I was showing you the chart, the ice cube will increase over time. Right? So number will increase and get larger. So use more money in terms of more money with an option that expires tomorrow. The same exact option last week. Last week on Thursday, with 8 days left in option, you would have lost the 3 cents. For it to expire tomorrow, you're going to lose like you're losing 60 cents. Okay. So people get this. You know, I sold an option. A week later, it's really gone anywhere, but I'm losing money. Ask them, let me guess, is earnings coming out in a week or two? And they'll be like, yeah, how'd you know? Oh, because you sold an option, and it is going to do what into earnings? It's an increase or decrease into earnings. What do you think? Yep, options volatility is going to increase into earnings. And if you sell an option today, and earnings are 2 weeks from now, next week the stock's gone nowhere, your volatility is now jumped 30%, well, lose money. So standing the right environment for the right option, okay? You need to be basically sell into earnings. You can pretty much anticipate that decreasing until that earnings number comes out. It's like today with Priceline, right? Priceline had earnings come out right after the bell. And I believe that the earnings for the tomorrow's options were over 100%. I don't remember the exact number. I'll have to take a look. But, you know, that's anticipating of options expiring tomorrow with earnings tonight. Tomorrow, that percent volatility is dramatically. Okay? So understanding the game you're playing and the risk that you're putting on is critical. So if you've got a Vega of 0.17, and 1% change in that implied volatility will change the option's price or lose you 7 cents, okay? Depending on your position's direction. Gosh, exactly wrong. a 1 cent move in your 17 Vega is 17 cents, right? So, you will lose or gain 17 cents. So think about this. Now let's start putting this all together. It's a delta of 54, and let's stock. Actually, let's build it. Let's just for fun. Let's build it, right? All new word. Because the thankful thing is that you have to worry about it. Your Trademonster platform will do it for you. You've got a 0.54, a 0.4 delta, right? And open this up. I'm going, what happened? Get at it. That's kind of what happened there. 0.54. And let's say we talked about is the 0.3 is the 0.17. We get a $1 move in the stock. Okay. So we know that a $1 move in the stock is making you roughly 11. Lose. Let's the volatility dropped 1% overnight because of that $1 move up. So a plus $1 move, negative $1. Okay. Once 1%. So that's your Vega, right? So this, you'll make 65 cents, lose 3 cents in time decay, and lose 17 cents in your volatility. So no, you did, you still made money. All right, about it for a second. You got a 54 plus 11. That. And then, oh shoot. Hey, where am I? Back up here. There we go. The computer is running very slow. So 5. Come on. And then it's out cents minus 0.17. So if you should have made some money on this, you still made out okay, right? But you've got to count all of your all weeks, right? So you've got this move where you get that the dollar move, and gamma moves up to 65 cents for you, and you lose time decay and you lose volatility. All right. And then there's an options price rise or fall as result in a 1% change in interest rates. Okay. We haven't had a lot of move in interest rates, so much of a concern. You really get a dramatic push. Interest rates that go 4 or 5 points before you anything significant. Even at that point, it's 1% change in interest rates, right? It's going to be options pricing. Okay, so an example here. Buy is positive. Gamma, you're going to and you're positive Vega. But you're negative on your delta, right? You're bearish. You're positive. So think about this in terms of a stock going up and a stock going down. You have positive gamma if it's going to direction, which means a higher delta number against you, right? It goes against you. Then getting a negative. So of 54, and now the stock drops $1. NAMA is going to work against you. You're going to be less bullish than you were, right? And then you've got your put spread. Now, the reason I put them this way, folks, is check the difference. Paul's bullish. Selling a put spread is bullish. So, see your delta is positive. Now, this change happens. Your gamma is positive, but a spread, your gamma is negative. And then positive, negative. Here at the spread, you're collecting that time decay. And it's a sold position, it's going to work against you. So you want to make sure that if you sell a put spread, the volatility starts to go away. Buy, you'll make money. If it's up, go. The more it goes up, you worry about that being worth anything, because pricing is going to go weird to think about. And take a deep breath with this one again. Okay, delta. You can close your eyes and think about this. Just put hand up. Delta's going up. Stock's going up. Options a negative gamma, which the pricing of my options is going to go down. That to have happened. I sold something. I want it to go down. Okay. And so that gamma is going to be negative. So this is a lot of crazy stuff. It does take a little bit to kind of get yourself wrapped around it. But if at worst case scenario, you walk away from this and go, well, that's a lot to know. Good. This is the stuff that will make you a good trader. You know, I'm in person that will come to me and say, and I get this all the time. I was just at the New York Traders Expo. I didn't have a booth. I was just walking on. I walked to a couple of people that I knew. And somebody came over and started asking me, anyone to give me any advice on trading. I'm not, okay. I'm like, no problem. I don't, that doesn't bother me. I do what I do. And they start talking about their trades and they don't understand what they're doing wrong. And going, well, you don't want to. But you do what you're doing. You have no idea what the Greeks mean, and you're expecting to sell premium on price line, wondering why it's going against you. Earnings are in 2 days, 3 days. Sorry, this was Monday. So the spread today's awesome for you. Today the market's closed. You're making money today, right? And they looked at me like right. I'm like, well, you do understand that since will day over time, every day of the week, 365 days of the year. So making money today because the volatility, the market's closed, you're having a time decay. So you've got a spread on, but you Omega to go down. You want volatility to sap away and increase over the next 3 or 4 days. So you buy back at a cheaper price. Yes, absolutely, Ron. I love to sell higher premium and then buy it back for nickels, right? That's what I love about doing calendars and diagonals. I will sell options next week, buy them back for less money. Longer dated option. So think about the parallel here. I'll have a longer dated option. Wind decay isn't going to affect it greatly. So I'll buy a 30-day option and I'll sell an 8-day option, right? So the two lines of time decay are different angles of acceleration. Does that make sense? No. Because I want to sell a call spread or buy a call spread. I want the velocity of that move on the for much more steeper and much higher velocity than the 30 or 45 days out that I'm buying. And I care about. All I have happen, folks, is that I make money on time decay, and the stock goes nowhere. Well, then next week I'm going to make money on the time decay loss off 8-day option, and I'm going to lose just a little bit on 3-cent time decay on a 30 or 45-day option. Mine losing 3 cents a day. It sold something that's making me 40 cents a day or 25 cents a day, where you can use these to your advantage. Right? So I can answer questions. Go live. The market's kind of closed right now. They have this deal where they close and they won't open it for me. So 4 o'clock it closes, and I just can't get them to open it for me. I'm sorry about that. So when you start looking at your positions, I want to your delta, your gamma, your theta, and your vega, and start to say, hey, you know what? Hey, I'm bullish on the spiders. I think the market's going to go up, and you buy a delta of a 0.15. You buy for like nothing. Would, but that's a very low probability of making you money. Okay, take a look. Hit on tomorrow. Go next. Here we go. So the 4. Perfect. Okay, so the 84 strike, which is 10 cents in the money, is going to lose 7 cents overnight. Okay, 7.5 cents. Now, 9. Okay, not the ones for tomorrow. That's these guys. Right. Take a look at these 3 different choices here. We got something that's going to expire tomorrow. The 84. See, look at that. Look at the thing on this. It's worth it. Okay, if you get this option right now, you're going to lose 24 cents of time decay overnight. So you asked me about if the theta is a constant, right? Here it is. You get 24 cents overnight tonight. Next week's option is losing cents, and 3-day option is losing 5 cents. I'm going to do a calendar or diagonal. I can go and buy an option here that lose 5 cents a day, and then over here, anything that's got 9 days out that lose 7 cents a day. Right? So I'm 3 cents on nothing happening. That's not money, but I'll do 10, 15 contracts. Right, on time decay alone. All right, so that's what I showed you, and I kind of explained is knowing what's going on here, so that way you can clearly have an understanding of what your trade's going to do for you. Right. Are there, by the way? I think I got to most of them. If I missed your question, I apologize. The calendars over verticals. I like verticals, but right now with the volatility way it is, I'm doing more diagonals, so I can kind of negate that the VIX being so low by buying and selling. I've been doing a little more because options have been pretty darn cheap. I've been doing more counter diagonals. Look at win trade for vertical and tell what the trade. Sure, absolutely. Now, let me give you my email address, by the way. Ralph at Omegatrades.com. Has been waiting. And we have that Greeks. Okay. I'm going to do this just a few minutes. Here, let's go to Trademonster to win, right? And vertical. If you're bullish on win and go out to like, the March. Okay, click over here, sell, create to a vertical, right? To edit the legs, because actually I made that as a one. So I want to sell the 220. Let's see, to buy the 215. Some success with any of the Greeks right now. But if you were to look at this trade, all right, this vertical spread, and this vertical spread, vertical selling, a call, a put vertical here. So vertical would be bullish, or be mainly on time decay. You want volatility to sap away, and this goes in my favor. I'm going to have the options reducing value. If you're on calendar to become the money, are you going to make money? You can. Rolled in the money calls and puts quite often and made money on this. Now they're in the money. Well, guess what? The odds for a couple of weeks out from now have extra time decay and extrinsic value in them, and I can make money on the roll. So you can definitely do that. Not necessary to lose, right? So that's definitely a possibility. So, folks, I do want to remind everybody, if you're interested, go to my website, which is Omegatrades or Omega Institute of Trading, and I'll give you guys a 2-week trial of my weekly coaching. And we do it Thursdays. So sign here. There's no credit card information needed. Just put your name, phone number, your email address. If you have any questions, you can email me, and just get a week, 2 weeks, of my coaching, which we do every Thursday at 3 p.m. Eastern. You can see how I trade, what I do, how we go through trades, putting on some verticals, putting on some calendars, discussing the differences between putting on a long ball and doing a vertical spread. So, just on, it's a free trial, okay? If you have questions, of course, you can email me, Ralph, at omegatrades.com. Questions, I'll be more than happy to, email me. I'll be happy to answer them for you. All right. I think I spread. I started to do my margin managing the Greeks. Well, if you tell a spread, the negative is because you've got 2 different options, Daniel. That two splits between your bid and the ask. So you got a bid and the ask, and bought or sold right between there. And you've got 2 different options that have point and the bid, and they have the ask. And the way you got filled, mostly you're going to be down the second you put that rate on because of the split. If there's a 10-cent wide between your split and your split between the bid and ask, you could be down cents on your side of that trade. So yeah, you could be down, but that's not because you're not managing the Greeks. It's just a split on the trade that you got in on. All right.
Honey, you did a lot of translating there for us, Ralph. You were on fire. Let's have a nice round of applause in the chat room for Ralph. He did a great job for us today with a very technical, necessary concept that all of you have to master. We all have to master. And everybody, we know active in the industry like Ralph is, and like all of us at Trademonster, we know that you want to be better traders. So we're all happy to come together in community and questions and make these presentations. We want you to be successful. That's the only way. And it's not a zero-sum game. If I'm making money in my trades, Ray can make money on his trades. There's plenty of ways for all of us to be successful. So tomorrow, it's Friday, and another expiration. So if you've got trades on, you want to make sure that you take a good look at them in the morning. Make sure that you don't have any expiration risk type or any assignment risk. We'll be sending out some notices to you that are Trademonster customers, of course. We've got something that is expiring tomorrow. So thanks again to Ralph, and thanks to everybody for coming out today. It was a nice group. You asked a lot of very challenging questions, and you kept the presenter on his toes, and he's probably going to be a better presenter because of it. All the time, we're always trying to get better. Thanks again, and we'll see you next time.